What's up, everybody? Before we get started on the show, I just want to give a quick shout out to our new Forward Guidance newsletter. It runs 5 days a week and talks about all things macro, digital assets, and how the two worlds are starting to collide together. I'm a writer for it at least once a week, as well as a very talented editorial team. And so check the link in our description to go sign up today. It's free and you won't regret it. All right, back to the show. All right, welcome back to another episode of Forward Guidance. And joining me today is Eric Basmajian of EPB Research. Eric, it's great to have you. Big fan of your work and how you track the business cycle. So it's really great to get you on the show today.
Yeah, it's great to be here. Thanks for the invite, Felix. And I was saying in the pre-show that we got to get you on the other side of the camera. So you've been posting a lot of great stuff as well.
Thanks, man. That means a lot coming from you. Look, I want to get right into things. I want to talk to you about business cycles, about where we are in the business cycle, how we just define different perspectives on the economy. So I just want to start from the top level here. And I know you prepared a few slides here to walk us through as we look through the process of actually defining a business cycle. But what is a business cycle? Why do we track them? And what's your definition of it? And what's your process for tracking it?
So I brought a few slides to help me walk through the way that I explain the business cycle and the process that we use. So at EPB Research, we focus on business cycles and primarily the US business cycle. And most people are familiar with this sort of sine wave representation of the business cycle, where we go through periods of expansion and periods of recession. And what this sine wave represents is aggregate economic activity, or you could think of it as the average person or the average business, or just sort of a overall blend of all the economic activity that's happening in the economy. But what is a little bit different about the way that I analyze business cycles is looking at it as an average or one representation of all people or all businesses is not really the best way to do it, because different parts of the economy move at different parts of the business cycle. So there's a sequence or an order of operations in which various sectors of the economy go through their expansion or their contraction. And if we go back across time, including this COVID cycle, which has been unusual for a variety of reasons, the sequence or the order of operations remains the same in every single one of them. The lead and lag time between each phase or each bucket that we're looking at here is a little bit different, but the sequence is always the same. So I like to sequence or separate the data into 4 major buckets, what I call leading, cyclical, aggregate, and lagging. And what I think is so important about this process is that when economic data is released, let's say in any given week, we could have building permits, industrial production, and retail sales all released in the same calendar week. And we'll largely make one characterization about the data was good this week or the data was weak for this week. But in those buckets of data that have come out, there were some data points that were leading economic data points. There were some cyclical data points. There were some aggregate data points. And by definition, they're not all going to move in the same direction every time. You could have weak leading data, mild cyclical data, and strong aggregate or lagging data. And that does tell you something about the direction or sequence of which the economy is heading. So when we're looking at leading data, we're mainly focused on things like the availability of money and credit, as well as soft commitments, building permits, new orders. Most people are familiar with this stuff, but what's important is that we're not measuring any economic activity in the leading economy data. We're not measuring any economic output, and we're not measuring any employment. The first time that we measure actual economic activity is in the cyclical economy, and there we're measuring production and employment very specifically in the construction and manufacturing sectors, because those are the 2 sectors that are the most sensitive to changes in money and credit, interest rates. And once those changes occur in the cyclical economy, once, let's say, the job losses occur in the cyclical economy, those people who become unemployed become the downstream stress on the aggregate and lagging economy, which is why you can never really have a contraction in the aggregate or lagging economy without it coming through the cyclical economy first. That's why that sequence always remains the same. The aggregate economy, as its name suggests, measures everything: total employment, total income, total consumption. And the lagging economy is very much service sector oriented data, services consumption, services employment. So, with that concept in mind, I like to put actual numbers or data to it. So, when we're looking at the leading economy or leading indicators, which I'm defining in this chart as the Conference Board LEI, which does a good job of capturing the yield curve, building permits, and new orders. As many people are aware, that leading data has been contracting and contracting pretty strongly for the last 24 months. We're measuring growth 24, 18, 12, 6 months ago, and most recently. The cyclical economy is the engine of the economy. This is where all recessions live and die, is in that cyclical economy of construction and manufacturing. And the cyclical economy has been decelerating. You can see 2 years ago, we were growing at 4%, then 1%, then 0, now a very mild contraction. The aggregate economy has been very stable, and the lagging economy has been growing very stable as well and above trend. All of these indicators were measuring both employment and production together. Before I conclude this, very brief summary of the framework that I use, I just want to highlight that aggregate economy for a second, which I'm quoting at 1.4% growth most recently. It's actually 1.5. This slide is very slightly dated. Many people push back and say, well, the GDP numbers are very strong at 2.5% or 3%. How is it that you're producing a number of 1.4 or 1.5? As you can see in that bottom right-hand chart, the aggregate economy, I'm measuring the 6 NBER variables that they use to define the business cycle. Those 6 variables are listed in this chart as non-farm payrolls, household employment, personal income, personal consumption, real retail sales, and industrial production. And we could see that non-farm payrolls is growing at about 1.5%. Household employment is about 0.6. Personal income is about 2.5. Personal consumption is up there in the high 2s. That's where the GDP numbers are predominantly coming from. Retail sales, which is tilted more towards the goods economy, is a little bit weaker. And industrial production is contracting mildly. So when you take all of these variables and you roll them up together, that's where we get the aggregate index, which this chart is updated. You can see that the latest reading is 1.5. I also put what's called the big four. If we go back to this chart, the big four just excludes household employment and retail sales. Some people don't like to use those, and they just like to use total payrolls, personal income, personal consumption, and industrial production. And if you roll up those 4, it's 1.8. So aggregate economy, aggregate economic growth is growing somewhere between 1.5 and 1.8. But what's really important and why asset markets are feeling optimistic is the stability of the aggregate economy. The aggregate economy and lagging economy is really where markets feed off of. And you could see for the aggregate index on the left side of this chart, 18 months ago, we were growing at 1.6, and today we're growing at 1.5. So there's been virtually no deceleration through the aggregate economy. And a big reason for that is that it's taken a very long time for the contraction to move from leading variables to cyclical variables, and they're still only contracting very mildly. So I'll take a breath there and stop. We can punch into any part of this process that you'd like. But just to summarize, I'm looking at the economy through 4 buckets: leading, cyclical, aggregate, and lagging. The process moves in the same order of operations in every business cycle that we know throughout history. Where we stand currently is a very persistent and ongoing contraction in leading variables. It's taken a very long time, 2 years, but it has finally started to move through cyclical sectors, albeit very mildly. And since the contraction has just started to show up in the cyclical sectors, we're still seeing a ton of stability in the aggregate and lagging economic sectors, which is where a lot of the market performance is coming from.
Okay, Eric. So I have a few gut ideas that I want to throw at you and see if we can prove out right or wrong the validity of them, and whether we can just point some data towards it. So my first question is something that a lot of people I feel like have been wondering is this business cycle different than normal? Has it been a weird business cycle? Because I think back to, say 2022, we saw, we had a negative GDP print. We initially had a second negative one, but it got revised higher previously. So that kind of came out, but it felt like people were looking at, economists were saying there was a 100% chance of a recession. That did not occur. At that time, we saw like a secularly hot labor market. Obviously, we've normalized there. So I hear a lot in the news and I see a lot in the data. It feels like we've been through a weird cycle. Do you agree with that? Or is it still tracking pretty fairly?
So I think that there's a lot of validity to that statement, and I'll unpack it there because I think the answer is both yes and no. So the answer is yes, that this is still a very normal business cycle as it pertains to the sequence of the way that the data spreads from the leading sectors to the cyclical sectors to the aggregate. And we can see that in the charts that I presented, that the cyclical sectors of construction and manufacturing are sequentially decelerating, and they have now moved into contraction. However, what is different about this cycle and what's made it very challenging is the lag time between when those leading indicators contracted, which was starting 2 years ago, to when the contraction appeared in the cyclical sectors, which is really just starting now, and it's still very, very mild. So that 2-year lag time, a 2-year lag time would be on the longer side from when leading variables spread to aggregate variables. But we're at a 2-year lead time of leading to cyclical. So we haven't even spread to the aggregate. We're still experiencing this very long delay of getting from contractions in leading sectors to contraction in cyclical sectors. But it is starting to appear. And even though it took a while, sequentially, we saw the decelerations. So the question is why has that happened? And to be entirely honest with the audience and in the reports that I've been publishing as well, it was extremely difficult, if not impossible, to predict that the lag time would be this long because there were so many extraordinary factors that came into play that created this really long lag time. The most proximate reason, in my view, is the production backlogs that were accumulated in the cyclical economy of construction and manufacturing, most specifically residential construction and motor vehicle manufacturing. So if we look at the motor vehicle sector, for example, the motor vehicle sector is one of the most interest rate sensitive sectors of the economy. Okay, so what I'm showing here is a coincident index for all the durable goods manufacturing subsectors. And durable manufacturing is where the monetary tightening is supposed to come through the economy. And if we had to pick one sector that's most important in the durable manufacturing sector, it would be the motor vehicle component, because as interest rates go up, auto loans get more expensive, auto sales come down, auto production then comes down, auto employment starts to contract. Those auto manufacturing employees are very important even to the US economy. And then, as our conceptual slides suggested, the layoffs or job losses that occur in the auto manufacturing sector and associated industries start to spread through to the aggregate and lagging economy like services and restaurants and things like that. The motor vehicle sector 2 years ago, as measured by employment and production, was growing at 5%. We went through a historic rate tightening cycle over the last 24 months, and the motor vehicle sector went from 5.5% growth to 0 as measured by employment and manufacturing. But if we go just 6 months ago, it was still growing at 4.4%. So we say, how could we have one of the most interest rate sensitive sectors of the economy not respond to one of the largest changes in interest rates? So what I'm showing on this chart is the full index, and this is an index that we create, which is both, again, employment and production. And we can see that going into the recessions like 2001 and 2008, there were very strong contractions in the motor vehicle component, which impacted the broader manufacturing sector, which then spread through. And the first point of criticism is, well, this is a really small part of the economy. It doesn't really matter. Mm-hmm. What I always say is that the volatility or amplitude of these sectors is so large that it is enough to spread through to the rest of the economy. So you get a 20% contraction in the case of the 2001 recession to a 40% contraction in the case of the 2008 recession. So if you have a 20 to 40% contraction in production and employment, even if it's a very small sector, that has a multiplier effect to all the ancillary industries, and it does end up impacting the more downstream or lagging parts of the economy, like restaurants, like services, and then you get weakness that appears there. So going back, what we had was in 2022, we had this historic rate hike cycle, but you could see that the motor vehicle sector did not ever contract. It powered right through the rate hikes. And so like, how does that happen? And some people, in my view, are making the argument today that the economy has changed post-COVID and interest rates are 5%, but the economy was able to power through those 5% interest rates, which means that we have a higher neutral rate and we can continue to perform with these higher levels of interest rates. In my view, I think that that's a misinterpretation of what's been going on. I believe that the auto sector, just to use one example, this happened in many different pockets of the economy, but the auto sector accumulated such a high level of backlogs in 2021 and 2022 that we all thought that it would take a matter of quarters to work off that backlog that was accumulated in these sectors. But it really took several years to work off the backlog that was accumulated in these sectors. So was the auto sector powering through 5% interest rates, or was it really performing based on backlogs that were accumulated off of 0% interest rates and very heavy consumer-facing stimulus? In my view, it was that one. And now we're starting to see the backlogs roll off the motor vehicle and other industries across the economy. Now we're starting to see these more cyclical sectors face the interest rates that are prevailing in the economy, which is why if we go back to this motor vehicle panel on the left-hand side, we see the more abrupt drop from 4% to 0 and the potential peak and rollover of this sector here. So I think that the economy has been unusual in the sense that we accumulated not just quarters of backlogs, but multiple years worth of backlogs, something that I certainly didn't appreciate when they first started. But with the benefit of hindsight, in my opinion, the data is clear that that's what's been happening. And I think that as these backlogs roll off and these very cyclical interest rate sensitive sectors begin to face the prevailing interest rates we have in the economy, we'll see more protracted weakness there, which will make the business cycle appear more normal. And going back to our business cycle sequence slide, we can see that these contractions in the cyclical sectors just started to appear, where I believe it was a misrepresentation where people think that we had a contraction in the manufacturing sector and it just didn't matter to the economy this time because the economy's is manufacturing's too small, when I think the data is actually very clear that we just actually never had the contraction in employment for the manufacturing sectors, when normally it appears much more quickly after a tightening cycle. So I think that's
Eric, I want to double click on that idea because I think it's a really important one, and it squares a few things that you're talking about here. So what you're saying is that, we've been looking at the manufacturing sector of GDP, which is, I correct me if I'm wrong, but like service base is like, I don't know, 2/3 of GDP and manufacturing is like 1/3. So we're talking about the 1/3, and then of that 1/3, like a very cyclically sensitive component of that index. So the argument is, the service side of things is doing pretty well comparatively. Yep. So, but what you're saying, it sounds like, is that what happens in these highly cyclically sensitive sectors, such as, new cars that we just looked at, has a cascading effect that trickles into those other components of GDP. Is that correct? And that's how the recession actually occurs?
Correct. Exactly.
If we're going to get a recession.
Exactly. So we have services, and services measures a lot of non-discretionary stuff like healthcare, food, prescription medications. Those things will never contract. They never contract even in recessions. But then we have some sensitive parts of the services sector, like restaurant spending, going to a Broadway show, things like that. Those are more discretionary, but they're not interest rate sensitive discretionary, right? So normally what happens in a business cycle, and again, it doesn't really matter how small the cyclical sectors are. What happens is interest rates go up, credit tightens, you get a downturn in the interest rate sensitive sectors, predominantly construction and manufacturing. Those people lose jobs. And then those accumulated job losses, they start to pull back on restaurant spending, discretionary services spending, auto delinquencies, credit card delinquencies. It bleeds to the financial sector. And then you see the services sector come down, which is why it's characterized as a lagging sector, because a bunch of things need to happen first before it gets there. The reason the economy has appeared so resilient is because we never got those manufacturing and construction job losses. Only really in the last 1, 2, or 3 jobs reports have job losses appeared in manufacturing. They still haven't appeared in construction. So we're just very, very, very beginning, starting to see some of that cyclical contraction as was anticipated by some of the leading indicators over 2 years ago. And in my view, we just had so many backlogs in these sectors, which again, I didn't appreciate to its fullest extent, which took a really long time to come through, where you had manufacturing companies that were living off of backlogs. And they, like we see in the ISM new orders index, for example, there's been a contracting level of new orders for basically 2 years. So nothing new is coming in the door, but they've been able to produce and keep people employed, just kind of living off of those backlogs that they've accumulated for so long. As that has now become exhausted, those sectors are now forced to face the prevailing interest rates and kind of live off of the current economic conditions. And I think that the data is starting to show that it's becoming more difficult for them to do that. The last jobs report was quoted as very, very strong. It was certainly a high headline number. The unemployment rate came down. But we did have job losses in durable manufacturing more broadly, and some of the very cyclical sectors, which I think is in line with that sequence that's been developing.
Eric, we managed to go 23 minutes here without saying the word housing when discussing business cycles. I want to, some people will say that, housing is the business cycle. So I want to get your perspective on what you're seeing in the housing sector and how that reflects where we're at.
Yeah, so housing is the business cycle. I very much like that Ed Leamer paper and that characterization. When we talk about housing, we have to get really specific about what we're talking about. We say the word housing and people immediately go to home prices, right? Yeah. Housing follows a sequence. And the statement housing is the business cycle is not home prices is the business cycle. It's really housing construction is the business cycle, right? Residential construction, because if interest rates go up, the volume of housing sales goes down, right? We still haven't talked about home prices, just the volume of housing transactions goes down. If the volume of transactions goes down, then residential construction starts to pull back because there's nothing for them to sell. Then you lay off the residential construction job losses, and then you go through that sequence, which we outlined for manufacturing, which is the exact same for residential construction. Again, we went through this period, and I wrote an article on my Substack about this, where home building companies, so residential construction companies, have inventory for sale. And we see a lot of charts on Twitter that show that the amount of inventory for sale for new construction is almost as high as 2008, right? And that's obviously caused a lot of alarm bells on Twitter and things like this. But home builders can list inventory for sale, whether it's under construction, not yet started, or completed. So you can, in theory, buy a home from a home builder from a booklet when it hasn't even been started yet, and that's listed as inventory for the new construction sector. Historically, these home building companies or residential construction companies carry about 30% of their inventory as completed. So if they're saying we have 100,000 homes for sale, 30,000 of them will be completed, and then 70,000 of them will be under construction or not yet started. That's the historical average, and it's a pretty tight band across history. In 2022, again, because of these backlogs and because of very, very high demand, 8% of the new construction inventory was completed. So 92% of their listed inventory was under construction or not yet started. So again, it kind of speaks to how we created such a dislocation in one of the most interest rate sensitive sectors of the economy that if the Fed raised interest rates to 10%, they still would have had to build so much inventory because they can't carry 8% of their inventory as completed. We're up to about 24% now. So we are getting back to those historically normal levels of, backlogs or inventory for the construction sector. But where we are, with that background, where we are for the construction sector is interest rates were moved up. We've seen a very depressed level of housing transactions. That was not spilling over to the construction sector because of those backlogs. It still hasn't, because we're still there. And when we get stuck in that part of the sequence, we can't move to the rest of the sequence. So we're still waiting for residential construction job losses to appear after the very, very pronounced decline in housing volumes, which is staying very, very depressed. Even as the Fed has kind of started this easing cycle, we're not seeing any pickup in housing volumes because the rates are very high, the affordability is really poor, but we're not getting that flow through to residential construction job losses yet. That's still something that has to flow through if this business cycle is going to manifest itself in a more complete business cycle downturn. So that's kind of where we are in that residential construction cycle. Very similar to manufacturing because those dynamics were the same, but there's still more to go there for sure.
Got it. Okay, so comparing some of these sectors that we just looked at here and where we're at in this early innings of this actual cyclical downturn that's occurring, when I look at some of the other growth indicators, like Atlanta Fed GDP now, when I've looked at just the recent revisions between GDP and GDI and what occurred there, it seems like we're also stronger than we expected. So when I look at some of these components and compare it to where we're at in this business cycle that you surmised here, if somebody's thinking that, we're, either in the very early beginnings of a recession, or maybe we're going to end up in one in the next few months, when I look at a Fed GDP now of 3.4% for Q3 as it stands, that feels pretty strong. So I'm curious, do we typically see that at these inflection points, and does that get revised lower later on as it catches up to the inflection point, or is this surprising how strong we're still seeing those GDP now forecasts?
Yeah, really important point. Okay, so if we go back to that business cycle sequence, we have leading, cyclical, aggregate, and lagging. GDP numbers would fall into that aggregate bucket, right? And GDP numbers, again, are predominantly measuring consumption. The consumption numbers are still, of course, very strong. The other thing that GDP numbers measure, which I don't measure in my indexes, is inventory contributions. So we have some swings in inventory contributions, which could help or hurt. Those 2022 recession numbers that you quoted, the 2 negative quarters, that was all inventory. It wasn't the real economic components of GDP. And then the GDP numbers also measure government spending because it's a direct contribution to GDP, which I'm not measuring in my indexes unless it flows through one of those 6 NBER variables. So I don't think the GDP numbers are that surprising in the context of we haven't really started to experience a very strong contraction yet in the cyclical sectors. So unless that occurs, you're not going to get weak numbers in the aggregate and lagging economic sectors. So for example, you are having really, really strong negative numbers in the cyclical economic sectors in 2006 and 7. And I'm not trying to relate this business cycle to that one at all. I'm just trying to quote the sequence because it was a business cycle manifested into a crisis, but it was a business cycle. And in 2006 and 7, you were getting very, very, very strong contractions in cyclical data points as I measure, in my charts there, much stronger than we're experiencing today. But you were still printing 2 and 3% GDP numbers at that time. And whether they get revised away or not is sort of irrelevant in my view. What's more important is how that cyclical economy, how that construction, manufacturing, goods cycle is developing. Is it feeding on itself and reinforcing itself to the downside? Or is it, self-reinforcing to the upside, which would be a very strong expansion? Where we stand today is we are sequentially moving lower in those cyclical sectors, but the contraction, as I showed in the charts, is still pretty mild. Certainly not strong enough to start pulling down the aggregate and lagging economy. So you're going to still print what are on the surface strong aggregate, GDP numbers. You're going to still print strong numbers there until you get a more forceful contraction in the cyclical sectors, both production and employment. So, the viewers can look at the employment reports and say, are we getting job losses in manufacturing and construction? The answer is yes in manufacturing, no in construction. And even in manufacturing, they're still quite mild. So we're moving in that direction, but it's definitely not strong enough at present to create, on the surface, really weak GDP numbers. So I don't think it's unusual. What I think has been difficult was foreseeing how long it would take to work through a lot of these issues in these cyclical sectors, which has prevented any weakness from occurring in the aggregate and lagging numbers, which is all the market really cares about. It continues to feed on itself because, earnings are printed in services and things like that.
I think that's a great segue to diving into the labor market, because I feel like a lot of the confusion in the last 6 months or so has to do with some of the data points that we've been seeing in the labor market. So I want to frame the conversation around two approaches. First off, how do you measure the strength or weakness of the labor market and your perspective on it? And then we can dive in deeper on some of the issues that we've been seeing in some of the data points afterwards.
I measure the labor market similar to how I measure the broader economy, in that I'm using a composite basket of various different indicators, because one indicator is never going to be the holy grail, and they're subject to revisions, they're subject to changes. But when you take a basket of 5 or 6 indicators that are all pretty good in their own right, it kind of weeds out some of the noise. So when I judge the strength or weakness of the labor market, I'm looking at what I call my coincident employment index. And that index is comprised of the non-farm payroll numbers that we all try and guess every single month, the household employment numbers, which have become more of a recent focus, but get a little bit less attention than the non-farm payroll numbers, the unemployment rate, aggregate weekly hours. So we're pulling in the weekly hours component as well as things like the insured unemployment rate, which comes from the jobless claims data. So we have a couple different reports, we have a couple different surveys, we have unemployment rate, we have jobs, we have hours. We're kind of putting them all together, and we're trying to get a sense of how is that whole collective basket moving. When we look at that basket, there was a period when the unemployment rate had its very sharp rise and it hit 4.3%, where that basket moved into the most fractional contraction. I think it was negative 0.1, which certainly should raise alarm bells. And it should raise alarm bells also in context of the sequence, right? If there were weaknesses appearing in some of the more leading sectors like construction and manufacturing, and then you saw a contraction in the coincident basket of indicators, that would be an alarming labor market signal. As the unemployment rate has ticked down from 4.3 to 4.1, we had a couple of sequentially stronger NFP numbers. That coincident index came out of its hair contraction and is somewhere in the 0.5% range now. So still positive, but it's what we would, but it's below the trend level of labor market growth, which is about 1.5% for that index. So when you're below 1.5%, you could say that the labor market is growing, but it's growing below trend. And that's where I would characterize the labor market now. And that's consistent with a deceleration in wage growth, a deceleration in the overall rate of inflation, all things that we're seeing now. But it certainly has not moved fully into a contractionary labor market situation, which would be synonymous with a recession. And given that sequence that we outlined, if that moved into a full contraction a couple months ago, it probably would have been a little bit premature, considering that we really hadn't started to see, or we still really haven't started to see enough weakness in those cyclical sectors to be consistent with a very pronounced slowdown in more lagging measures, of which the labor market really is. So labor market is still growing. It's growing below trend. In my view, based on the sequence that I'm measuring here, we should expect those decelerations to continue. And as I see a more forceful contraction in construction and manufacturing, then I'd certainly be on the lookout for that contraction to appear in that coincident index, which would be really synonymous with the onset of a recession.
Got it. Okay. So I really like that approach of, looking at the top down, trying to aggregate, because as we're about to talk about here, when you look at some of these individual components of the labor market data, there's some issues with probably each of them. So it's great to look at the top down and see what that's telling you. So first off, as you mentioned, this is a coincident index. From what I hear and what I gather, components like jobless claims, sometimes people view those as more of a leading component to the labor market. So when I look at jobless claims right now, they're pretty good. We saw an initial bump up. We've seen some increases lately. It's hard to see how much of that is signal versus noise due to hurricanes and strikes and the like that have been occurring. But I want to ask you, what's your perspective on jobless claims and it being relatively muted compared to what we've seen in terms of the increase in the unemployment rate? And on top of that, do we often see big revisions in jobless claims? And what does that infer in terms of a leading indicator into those other components that you mentioned?
Jobless claims are one really important component of a broader basket of leading employment indicators. So the same way that we roll up, 5 or 6 coincident employment indicators, we should look at a collective basket of leading employment indicators. And jobless claims are absolutely an extremely important part of a good leading indicator basket. Um, Other components that would be important would be things like hours worked, particularly in the cyclical sectors like manufacturing. There are other important indicators like profit margins and profits of cyclical businesses as well. So you want to be looking at a broad measure of leading employment indicators. Broadly speaking, that basket of leading employment indicators is weakening. We see all the steps that businesses would take before they actually lay off people occurring. For example, they're cutting hours worked, they're shifting to more part-time versus full-time labor, they're reducing temporary help workers, which is a component of the non-farm payrolls report. So all of those things are occurring. However, we're not seeing a very significant rise in jobless claims. Why is that? Well, jobless claims are predominantly filed, and this is you can look, the BLS has put out a note of the propensity of various industries to file jobless claims. And some of the industries that have the highest propensity to file jobless claims are construction and manufacturing. So considering that we haven't seen very sharp job losses or layoffs in construction and manufacturing, that is consistent with a still muted level of jobless claims. We're seeing a trickle higher, and if you really squint, it's moving, a little bit to the upside. You can do your best to strip out some of the noise. You can try and look at the non-seasonally adjusted numbers, and we're seeing a very, very, very gradual rise off of a very low level. But the propensity to file those claims is most strong in construction and manufacturing, and for all the reasons that we talked about in this conversation, that hasn't started to appear in a very dramatic sense yet, which is why those numbers are still appearing muted. But if I'm correct in my assessment that the sequence will continue to move through, we'll get a more pronounced contraction in the construction and manufacturing sector, then we should be on the lookout for jobless claims to move up in the future, which would be an incredibly important signal, because that would confirm the collection of other leading employment indicators that have started to weaken a lot, like Conference Board labor market differential, the quits rate. All of these things are signaling a weakening labor market, but a weakening labor market that's consistent with employers trying to do things to protect margins, but not taking that step of heavy layoffs yet. So if we see the construction and manufacturing sector weaken with that rise in jobless claims, that'd be a high conviction signal that the labor market has moved into the layoff phase, and you will start to experience some of that more downstream stress in the sectors of the economy that are more stable. So jobless claims, very, very important within a broader basket. They're still signaling a environment that's not very heavy with layoffs. But should that start to appear, that would confirm a lot of the earlier indicators that we are seeing of companies trying to do things to, protect margins in an environment where wages did have this large rise 1 year ago, 1.5 years ago.
What do you think about the theory that's going around that the reason jobless claims haven't surged is that people, instead of, when they get laid off or for whatever reason, instead of going to file for jobless claims, they decide to go drive for Uber and or DoorDash or something like that instead, because the money's a bit better to just pick up one of those jobs as opposed to filing for jobless claims.
To some extent, I would like that to be true, because then it would indicate that the labor market's further along than I believe that it is. But I don't see the strong evidence of that, because again, the propensity to file claims is really from the construction and manufacturing sector. When you match that up with the NFP numbers, we're getting the very beginnings of manufacturing job losses now, which I do think will get more intense. But as of right now, they've been quite small. You're really not getting any material job losses in any of the major construction sectors. So I don't think that that's the reason that jobless claims are remaining low. If we saw heavy job losses in construction and manufacturing and no pickup in jobless claims, then I'd say, okay, there's got to be another explanation here. But I don't see that as the reason why jobless claims are remaining low. And I'll have to confirm the statement that I'm about to make by looking into the details. But if someone goes to drive for Uber, I believe that they would be considered employed, at least in the household survey of employment. If you called and asked someone, "Are you employed?" and they're driving for Uber, they should say yes.
Yeah, like part-time for economic reasons, I think, or something like that.
Right. So you'd see a commensurate rise in the job, hiring numbers or job numbers, but that household survey has been very weak, right? So I don't think that theory stacks up for me. I think it's more that we just haven't had enough job losses in construction and manufacturing to bleed through to jobless claims, which is indicative that the labor market is not fully in the layoff cycle. Now, some people will say, well, we've had this steady stream of headlines of tech companies doing these layoffs for multiple years, and that certainly is true. But as my whole process outlined, that tech sector doesn't really filter into that cyclical economy. Those people don't have a high propensity to file jobless claims. They tend to be able to get uptaked into the labor market more quickly. They have usually larger cushions of savings to keep them, spending and things like that. So it doesn't stack up for me.
So let's talk about the elephant in the room, which is non-farm payrolls and some of the revisions that have been occurring there. So the current mainstream idea is that we have had non-farm payrolls that have been somewhat okay, but we keep getting these substantial downward revisions, and this has been happening for many, many months now. Climaxed with the major revision that came of something like negative 800,000 jobs. So there's a lot of discussion and thoughts that, okay, we're actually, much weaker than the initial print suggests. So first off, I want to get you to mechanically unpack, how is the non-farm payrolls actually, that first print figured out? And then how do we get these revisions that get to a final print? Because it's my understanding that obviously we have a survey that gets linearly extrapolated to find some sort of confidence interval that gets us roughly right, and then it gets validated through tax receipts that come in. Is that correct? And how do you unpack that? And then how do you deal with this narrative of downward revisions in your labor market analysis?
So you're exactly correct in the way that the number gets calculated. You're spot on, and that's why the number gets sequentially better as we get more confirmation from more hard data like tax receipts versus the extrapolations. That linear extrapolation that you mentioned is why the revisions occur. And most importantly, the revisions generally occur in the direction of economic momentum. So I think that there's important signal in the revisions. I don't use them, in my process. I don't have an indicator of revisions. But when we look at the revisions and we sort of take a rolling average or a smooth average of them, we can see that the revisions tend to occur in the direction of economic momentum. So as the labor market has been cooling, right, we went from 500,000 jobs per month to 4 to 3 to 2, and the latest 3-month average is 150 or something around there. We've been in this decelerating, still growing, but decelerating environment. And that's caused those linear extrapolations to miss to the upside consistently. And they'll continue to miss to the upside so long as the direction of economic momentum is to the downside, because those linear extrapolations will always be to the upside. In 2021 and 2022, when the economy was strongly accelerating, the revisions were always to the upside, right? Because those linear extrapolations were missing it to the downside. So I always take some signal from the revisions, in that the revisions always occur in the direction of economic momentum. I don't take it any more seriously than that. It's more of just an observation. It's more of a confirmation of the whole process. If we go to some of those first charts that we showed, we can kind of see that sequence is one of a decelerating process, a still growing but decelerating process. You stack that up with consistent, negative job revisions. That makes a lot of sense. I do not think it's anything political. I do not think it's anything nefarious. People believe that very strongly. I mean, I have no evidence to suggest that, and it just makes a lot of economic sense that it always occurs in the direction of momentum. So that's the way that I look at the revisions. I would expect the revisions, therefore, not every single month, but on average, to continue to go into that direction. So, Powell made a comment that he's kind of mentally adjusting the numbers downward a little bit. I think that's perfectly appropriate. We can argue over how much we should, knock off from the number, but somewhere in the area code of like 30K or 40K or something like that seems perfectly reasonable.
Yeah, I'm glad you brought that up, because that's sort of how I've been dealing with it, and I wanted to gut check whether that's valid. Is because, as you say, it's a linear extrapolation. It's not convex, so you can just, I don't know, like last month we had a really hot job sprint, but you could just throw a 30% haircut on that or something, and just look at still the delta change in the actual jobs report and still get signal from that, right?
Yep, exactly right. So it's not to say that the jobs was, that it was a really hot jobs number and it's actually like, we actually lost jobs instead of adding jobs. Like, it's nothing so extreme as that. But, I think that, Powell's comment, and, we could argue about the Fed all day long and how they've done a poor job or a good job, but they do have a lot of data. They do look at a lot of information. He's got a lot of people on his team. It's not too difficult to figure out that the revisions have been consistently negative and kind of follow a business cycle type of a pattern. So I'm sure he didn't make that statement just like out of thin air. So I think it's appropriate that we can sort of mentally haircut these numbers if we were going to look at one number, like the non-farm payrolls, but we really should try and look at a broader collection of them and try and make our assessment that way, which sort of reduces the reliance on the face value number, at least at first.
Yeah, I fully agree. I think that's really going to be the emphasis and takeaway here as we go through and just look at some of the issues with each one. But as you aggregate them, start to get a better signal. So, okay, the last one I want to talk about is the unemployment rate and the dynamics of what we've seen there in terms of, increased labor supply and how that's been affecting it. So just to set some context here is that we've seen the unemployment rate surge, and we actually saw the SOM roll get triggered. Now, what I find really interesting is after last month's, if you use the unrounded numbers on the unemployment rate, we've actually seen the SOM roll reverse below that threshold number. And I haven't looked to see if that's actually happened before, but it really just frames the conversation that there's a lot of noise around the unemployment rate right now. So how do you cut through that noise, and what are you seeing on the unemployment rate?
Yeah, so at the risk of sounding repetitive, to cut through that noise, I kind of roll up the whole basket to look at the whole thing. But what's important about the unemployment rate is of all the numbers, it actually tends to be revised the least of all the numbers. So if you had to look at one number, it probably would be the unemployment rate, because you are looking at both a numerator and a denominator and stacking it up that way. So it is actually a good indicator of what's going on. In terms of, is it going up because of labor supply, or is it going up because of, more negative labor market phenomenon? I think that I don't think that question has been fully answered. And I think people are looking for an answer of it's all labor supply or it's all negative factors. And, I've read a lot of really strong analysis from people in both camps. And I think that the overall answer is that, of course, almost like always, there's some contribution coming from both. There's absolutely some labor supply increase that's going on. There was really negative labor supply in like 21 when immigration was very low. There's stronger labor supply today. There's obviously also some negative labor market dynamics that are going on as well. We can't dispute, again, that whole basket of labor market indicators that are signaling weaker conditions, like the quits rate going to levels seen in like 2014. If the labor market was so strong, why are people so afraid to quit their jobs and go look for another one, that's generally a sign that the labor market is not so strong and people cannot go easily go get a new job, or dynamics like that. So I think that there's contribution coming from both elements. I don't spend too much time focusing on that because that to me is a analysis that's very labor market centric, that makes it sound like the economic cycle begins with the labor market, when I think that we can get a more appropriate read on the cycle by looking at the sequence coming from the earlier indicators, spreading through the cyclical indicators, then spreading to the aggregate of which incorporates the broad labor market statistics. So I think that as we see more weakness pile up in the cyclical sectors following the leading, then we'll see more pronounced weakness in the coincident labor market statistics like the unemployment rate. And then that argument will become a little bit more of a moot point. So I think that that's kind of the way that I would take a look at it.
Basically, what we've just done here for the last 50 minutes is map through everything that the Fed looks at to basically drive their reaction function in monetary policy. Something that you mentioned at the start of the show was around R star and neutral rates. So just to finalize this conversation here, and in terms of how the Fed is reacting to all the economic data that we just ran through, is it feels like one of the big discussion points these days is the neutral rate, R star, however you want to call it, where it is. And then the question of whether we're restrictive, how restrictive we are in terms of monetary policy. And then finally, how that reflects into the number of cuts that are priced and actually occurring. So first off, I want to ask you, what's your perspective on R star and neutral rate and where it is? Like you mentioned, a lot of people think it's higher now post-COVID. I believe you believe that, we're still roughly in the same camp. So I'd just love for you to unpack that first.
Yeah, so this is the million or maybe $1 trillion question, right? If I could nail the neutral rate exactly, right? So the problem with the Fed is their perception of the neutral rate kind of just changes with the market, right? So like they were consistently lowering their neutral rate, and now they're raising their neutral rate, and they kind of just follow the market, which is what most people do, which is why people are now saying that the neutral rate's higher as well, right? Because we've been in this higher rate environment. Seemingly nothing bad has happened except a little bit of a banking hiccup, you can call it. But that is not an unrelevant or irrelevant development. But we'll leave that to the side for a second. So where is the neutral rate? Is it change? No one knows where the neutral rate is, and Powell says this, and it's a reasonable comment that you only know about it like when it appears, right? You kind of like. If something really bad happens, then the interest rates are too high. If the economy is running really hot, interest rates are too low. There's a whole bunch of theory and models that you can use to get there. I personally don't believe that the neutral rate is much higher than it was pre-COVID. I don't think that we've had sufficient evidence yet to the contrary because of the production backlog phenomenon that we were discussing about earlier. Because if the economy was generating employment off of 2021 and 2022 accumulated backlogs, then we can't say that the economy was powering through today's interest rates. And in fact, it may still occur that as those backlogs wear off and the employment in those sectors starts to contract, then we'll reveal how the economy really is facing the interest rates today. So I still don't think that we've had sufficient evidence to say, well, it's been 2 years since the Fed raised rates and nothing happens. That implies a very linear type of framework that leads and lags always have to fall into the same bucket. It can never be different. And while I certainly didn't think that lead and lag times would stretch to as long as they have today, I think the data is clear that it still is working through the process, because if you go back to those earlier charts, we would see improvements in cyclical growth. But we're not seeing improvements in cyclical growth. We're seeing huge declines in the number of housing units under construction. Yes, some of it is multifamily, but that is a part of the economy. We're seeing now contractions in various manufacturing sectors, contractions in manufacturing employment in various sectors. All of those things would not be consistent with an economy that's accelerating through today's interest rates. To me, that's an economy that is feeling monetary restraint still. but it's still a minor level of contraction, which is why it hasn't spread through. To
Got it.
answer the question of are we restrictive or are we stimulative? The way that I answer that question is I look at the variables that the Fed has the most immediate control over in the economy. And when you look at that, you think of things like the yield curve. You can look at the change in monetary growth, so money supply, for an example, and the rate of housing transactions. If the Fed was really easy, you'd have a steep yield curve. You'd be creating an above trend level of money supply growth in the economy, and you'd have a robust level of housing transactions, because that would imply that the consumers are feeling optimistic about the housing market situation, and rates are creating an affordable housing situation, and you're getting an acceleration in housing volumes. That acceleration in housing volumes would create more consumption of housing related durable good items, and you'd get a nice positive upward spiral in the economy. But when we look at those factors today, we still have a very deeply inverted yield curve, and the Fed has not been doing quantitative easing for a very long time, which I think dismisses the argument that it's a sort of a manipulated rate. I think that the yield curve is inverted for a very legitimate reason. That inverted yield curve is creating a below trend level of money supply growth. Money supply growth was contracting. It's no longer contracting. But if you look at the current rate of money supply growth, it's currently about 1% to 2% in nominal terms, whereas pre-COVID, money supply growth was growing at about 6% per annum. That's what the economy needed to generate its 4.5% nominal growth. So money supply growth is only about 1% or 2% right now, and housing transactions are incredibly depressed still. So in rate of change terms, monetary restraint is lessening, right? So we see that from contracting levels of money supply growth to now positive but below trend levels of money supply growth. We saw an inverted yield curve to a less inverted yield curve, and we really haven't seen anything on housing volumes. But when you take that whole constellation, you have a below trend level of money growth, you have a still inverted yield curve, you have a muted level of bank lending activity, and you have a very anemic level of housing transactions. All that to me signals that the Fed is still in a restrictive stance, albeit less restrictive than they were several months ago, but still restrictive. I don't buy into the theory that the S&P 500 is the barometer of whether the Fed is restrictive or not. And I made that as a serious comment because there are very serious debates going on about, well, if the S&P is going down, that means they're restrictive. If it's going up, that means they're not restrictive. On its face, that doesn't make a lot of sense to me, because that would mean that the Fed was hyper restrictive in 22 and hyper easy today, even though the policy rate's much higher today than it was back then.
Got it. Okay, so to tie that all together, basically we were decently restrictive, now we're slightly less restrictive, but because of that framework, am I right in thinking that you believe that the Fed could get their 75 bips of total cuts by year end without inflation reaccelerating? Because that seems to be the fear now, is that, okay, we're not in an outright recession, but we're cutting rates. We just cut by 50. Inflation is going to rebound. But if we're still in the somewhat restrictive territory, am I right in thinking that you think that that's not the major concern at this stage?
Yes, that to me is my position. I think that the way that inflation would reaccelerate, or the way that you would look at, could the Fed achieve the soft landing, or are they going to stimulate into an accelerating economy, would be if you go to that first chart that I showed with the leading, cyclical, aggregate, and lagging. Right now, we have contracting leading indicators. We have decelerating and the very beginnings of a contraction in cyclical indicators, and then still strong aggregate and lagging. As the Fed cuts interest rates or reduces their restrictiveness, we should see an improvement in those leading sectors, the very left side of that chart. If we see those leading indicators go from negative to positive, before we see a very significant contraction in the cyclical sectors, then what you would have is an economy that's going to reaccelerate before any contraction or any recessionary conditions appear in even the most cyclically sensitive sectors of the economy. If that occurs, then you're not going to ultimately get the contraction in the cyclical economy, which means you're not going to get the downstream contraction in the aggregate and lagging, which is ultimately what defines the recessionary process. Considering that leading indicators, broadly speaking, as defined by monetary growth, yield curve, building permits, new orders, the whole gamut, considering that those are still declining and the sequential direction of the cyclical economy is still to the downside, I don't believe that the proximate risk of the next rate cut is a reacceleration of inflationary conditions, because the predominant source of the above trend inflation, as it almost always is, especially if you exclude energy, comes from the cyclical sectors of housing and manufacturing. The very significant inflation that we experienced was in housing and durable goods, with 30, 40% durable goods inflation. As the manufacturing sector has rolled over, that has gone from basically like hyperinflation of durables to now very mild deflation. That's what's changed the direction of the overall inflation regime to one of a decline. You still have some residual housing inflation from shelter as the measurement is a little bit lagged. But to me, that's the predominant source of inflation, or when an economy gets overheated, is always through those cyclical sectors. And those cyclical sectors were growing, at its peak, 7, 8, 9% in real terms against a trend of 2 that created tremendous inflation in those cyclical sectors. Now that's reversing. So I think that, if those leading indicators were positive and accelerating, and then we saw that come through the cyclical sectors, then we'd have a more proximate risk of a reacceleration of inflation. But I don't think that's the risk now, particularly when we're talking about the Fed going from 5 to 475 or 5 to 450. It'd be, I think, a different conversation if we were talking about 2 to 1.
Well, look, Eric, that was a ton of fun. It was really great. One of my favorite parts about this job is just being able to throw questions I've been wondering at smart economists like yourself. So I really appreciate that. Eric, if people want to go find out more about you and your work, where can they go? Sure.
And thanks so much for having me on. It's a real pleasure to be able to walk through the process. And thanks for giving me a forum to kind of go through step by step. So you can follow me on Substack. I publish some stuff, pretty regularly. I'm also pretty active on Twitter at EPB Research. And what I do for clients with my subscription and consulting related services is very much just provide consistent and regular updates to this sequential process. We don't inject a lot of opinion into it. We're really just looking at how is this process developing from the economy's most leading sectors to the most cyclical sectors, then to the aggregate and lagging. And depending on who you are, whether you're a business owner or an asset manager, you may find that a different sector of the economy is more relevant to you. If you're an asset manager, you're going to be very much focused on the aggregate and lagging. But if you're a manufacturing company, you certainly don't have the benefit of waiting as long for those developments to occur. So that's where people can find me, and that's the work that I publish to clients. And thank you very much for the invite.
Awesome. Thanks, Eric.